Hi, I'm Rob Williams, a tax director in BDO's London Real Estate and Construction Sector team. To set the scene, it's worth putting into context the volume of change we have seen to real estate tax rules in recent years. The changes have been significant and in many instances wholesale, rather than merely targeting contrived tax avoidance schemes. This slide shows the main measures I will be touching on today, but even these are a drop in the ocean compared with the complete list of tax changes impacting the real estate sector. In many instances, the interaction of the changes is itself problematic. Often dealing with the impacts of one change puts a business firmly in the crosshairs of another. What we have here is a typical UK investment property structure. Investors, some of which will be offshore, investing into UK property through an offshore holding company and subsidiary located in perhaps Luxembourg, the British Virgin Islands, Channel Islands or the Isle of Man. The PropCo will have a subordinated shareholder loan as well as bank debt. This has been the default real estate structure for several decades, giving deductions for interest on both the bank and shareholder loans as well as a tax-free exit, whilst the non-residence of the PropCo would generally mean no UK withholding tax on interest. The main risk with this type of structure was transfer pricing, and specifically whether the terms of the shareholder debt are market rate. Today, when we are asked to consider how new UK property investment transactions should be structured, we have to consider the fact that from April 2020, non-resident landlords will be brought within UK corporation tax, the key impact being the new corporate interest restriction and anti-hybrids rules that were introduced for corporation taxpayers in 2017. The anti-hybrids rules are designed to deny a UK tax deduction for payments made under a hybrid financial instrument, for example a debt for the payer but equity for the lender, and or to a hybrid entity, such as a partnership that is treated as tax transparent in one jurisdiction but opaque in another. So in this structure, the shareholder loan might be vanilla. However, if this loan was itself funded by a profit participating loan, from April 2020, this may well be regarded as an imported mismatch, with the result that interest deductions in the PropCo are disallowed. In some cases, this will need substantive restructuring, such as re-domiciling to another territory. In others, though, a more straightforward change to the terms of the shareholder debt may be sufficient. In addition to the anti-hybrid rules, late paid interest rules may be an issue. These rules are only applicable to corporation taxpayers and defer a UK tax deduction for certain interest, where it is not paid within 12 months. Whilst they've been around for a long time, they generally only now apply to closed companies in tax havens, but they do still require consideration. We still regularly see investment structures using payment in kind notes, and these rules make it important to remember to issue the PIC note to secure the UK tax deduction. The corporate interest restriction rules, which implement the OECD's BEPS Action 4, restrict tax deductions for financing costs to the lower of 30% of tax EBITDA, a group ratio percentage, and a £2 million de minimis. This means that net financing expense above £2 million may be restricted. Under a group ratio election, groups should generally achieve a full deduction for third-party financing costs, but deductions for related party financing costs can be further restricted. Detailed analysis is required to confirm the deductions. This should be done early on based on forecasts and not left until late in the compliance cycle. This is because one of the key elections, the Public Benefit Infrastructure election, must be made before the accounting period ends. So what are groups doing following the corporate interest restriction? Well, some simply have to concede that there is no longer a benefit of having shareholder loans and using preference share funding instead. Others are looking to partner with third parties and establish joint venture companies. For example, a 50-50 JV should generally be a separate group and have its own £2 million worth of tax deductions for financing costs. Others may achieve a similar result if they do not consolidate their property SPVs. Or We have advised on other situations where an orphan structure achieves an equivalent result, i.e. has its own £2 million of tax deductions. If none of these routes are commercially viable, various corporate interest restriction elections can be considered. In addition to the public benefit infrastructure election and group ratio election referred to already, there are broadly another dozen elections which may help to manage and maximise tax deductions. Moving away from corporation tax, it's worth highlighting a couple of other recent developments impacting real estate investors. Firstly, new economic substance rules have been introduced by the Channel Islands, the Isle of Man, and other commonly used offshore jurisdictions from 2019. These will not apply to real estate investment SPVs, but may apply to holding and financing companies. A risk with the new economic substance rules is that it may lead to tax authorities challenging the tax residency of propcos. If successful, this could mean that the propco is liable to UK tax on its worldwide income and gains, and potentially also withholding tax on interest. And that leads on to withholding tax. While HMRC's guidance has for many years been that the residence of the paying entity is critical in deciding whether interest has a UK source or not, recent cases leave some doubt. If the reaction to the corporate interest restriction, economic substance requirements and new tax on non-resident capital gains, which we'll talk about separately, is to bring property companies onshore, they may now, for the first time, be subject to UK withholding tax on interest. Real estate investors therefore need to consider the basic tests. Is the interest short or annual? Is recipient in the EU? But Brexit could change things in this regard. Is treaty relief available? And on the question of treaties, the OECD's BEPS Action 6 has restricted many treaty benefits where there is a tax avoidance purpose. And this has led to changes to a number of treaties over the last couple of years, with more likely to follow, including the UK-Luxembourg Treaty, which is currently being renegotiated. The number of withholding tax failures we see in due diligence exercises never ceases to amaze. Turning to developers, take a non-UK company that's developing a UK site. In the past, the non-UK company may have claimed treaty exemption from UK tax. We know that the revenue never liked or accepted this, but for many years struggled to do anything against it. But from 2016, all profits from trading and developing UK land are within the charge to UK corporation tax. And this has meant that from 2017, developers are also within the scope of the anti-hybrids rules and corporate interest restriction, amongst other measures. Previously, it could be assumed that the accounting profit for developers would be the same or very similar to the taxable profit. Now, though, developers are facing restrictions for financing costs. They also need to consider whether to capitalise or expense financing costs in the accounts. Capitalising throughout the development and releasing them to profit and loss when the completed units are sold runs the risk that the interest will be more than the £2 million de minimis in the period of sale. The company may then never achieve full tax relief for the financing costs incurred. Expensing the financing costs each year could help, but not if all it does is create tax losses carried forward. This is because the new loss rules can restrict brought forward losses to 50% of profits, subject to a £5 million de minimis. Again, the company could end up never obtaining full tax relief for the costs incurred, and instead be stuck with tax losses that are ultimately extinguished on cessation of trade. Developers should therefore model these issues at the outset of a project to prevent tax leakage. And all of these issues can impact on deferred tax recognition as well. Finally, there are the recently amended transactions in land provisions, which can recategorise what would otherwise be a capital disposal to be taxed as a trading transaction. In this structure, if the non-UK holdco always had the intention of selling the shares in the devco, there's a risk that the holdco will be taxed on the sale of the devco's shares. In that case, expensing financing costs during the development period in the devco could at least give rise to tax losses that may be group relieved to the holdco to offset the transactions in land profit. Given all the pitfalls associated with traditional investment and development structures, We're starting to see interest in establishing or restructuring into new or existing but historically rarely used structures as a solution to these issues. There have been a proliferation of new UK REITs over the last couple of years, but we're increasingly talking to clients about PAIFs, contractual schemes, and certain other vehicles that were previously seldom seen. Whilst some of these regimes have significant tax benefits, they don't work for all investors. REITs and PAIFs, for example, will not work for companies looking to do a mixture of property investment and development. A possible alternative in that situation is the investment trust structure. To date, this has scarcely been seen as a vehicle for investment in UK property, but it has some flexibility and can achieve an equivalent or even better tax result. Why is this? Well, the investment trust is exempt from UK tax on gains. This means that property held by it directly can be disposed of tax-free, with sales of property-owning subsidiaries also entitled to exemption. Unlike the UK REIT and PAIF regimes, however, it is not limited to property rental activity. Accordingly, an investment trust might be suitable for pub and hotel groups, as well as property developers. The investment trust and its subsidiaries will not benefit from tax exemption on income profits, but unlike the traditional structures featured earlier, where it may no longer be possible to mitigate UK taxes on income using shareholder loan funding, the converse is true for investment trusts, as an investment trust can obtain a tax deduction for the payment of interest distributions, with any interest distributions specifically excluded from the corporate interest restriction regime. So what we have is a regime that is capable of minimal or no corporation tax on income, no tax on gains, applicability to both traders and investors, and it can be entirely UK-based, thereby alleviating the need for offshore management as often was required in the past. Furthermore, for mixed trading and investment groups, it's possible to convert from an investment trust to a UK REIT or a PAIF at a later date if the balance of the group's business moves towards investment. The investment trust regime has its conditions, such as a requirement for the trust to be non-closed and its shares to be admitted to trading on a regulated market. However, its conditions in general are less onerous than certain other structures. So I've tried to address some of the pitfalls coming out of the many recent UK tax changes and how these are impacting real estate structures, as well as offering some light at the end of the tunnel. If you have any questions on the back of this, please do get in touch with me afterwards.